On the surface, everything looks great, right? The market seems calm, maybe even a little too strong. But today, we're not just going to look at the headlines. No, in this explainer, we're going to peel back the layers and look at the subtle but, really significant cracks that are starting to form just beneath that calm surface. So let's start tapping on the walls, see what sounds hollow.
And yeah, that really is the theme for today. This quote, it just nails the feeling that, despite the market's big upward march, there are these disconnects, these weird little dislocations that they don't quite fit the mainstream everything is totally fine story. So let's start digging, shall we?
All right, so where do we start? Well, our first piece of evidence, our first little crack in this whole facade, it actually shows up thousands of miles away from Wall Street. We're starting in the Japanese bond market, and I know what you're thinking, but trust me, what happens there can have some surprisingly huge ripple effects across the entire globe.
So what are we looking at here? Well, this is the yield on Japan's 10-year bond, and it's pushing to new highs. But look at how it's moving. This isn't some chaotic, all-over-the-place spike. No, it's a steady, orderly climb. It's staying right inside that predictable path, that trend channel, and it just keeps breaking past those old plateaus. This isn't just random market noise, folks. This is a sign of some serious building pressure. So is this thing just unstoppable? Because this pressure, it's not just in the 10-year. If you look at the longer-term bonds, like the 30-year, the move is even more dramatic. They've smashed through some really big resistance levels, and now, well, there's not a lot of technical stuff left to stop them. Traders have a name for this. They call it a vacuum to the upside, and it means prices can move up really, really fast.
Okay, so why should you, an investor, maybe in New York or London, care about bonds in Tokyo? Well, it's simple. Global money is all connected. When those Japanese yields rise, it can literally pull investment capital out of other assets, including US tech stocks, because investors are chasing those higher returns somewhere else. And hey, this isn't just a theory. We've seen this movie before. Just look at this timeline. Back in late October, Japanese rates started to surge, and what happened? The tech-heavy NDX index plunged almost immediately. It was like clockwork.
So here's the bottom line. While Japanese government bonds, or JGBs as they're called, aren't usually on the front page for most investors, a big stress event in a market that huge can easily spill over and wreck global sentiment. A nervous JGB market, that could be the one thing that finally wakes up the VIX, the market's so-called fear gauge.
But hey, this isn't just a story about Japan. That first crack we found, it's starting to spread. We're now seeing similar disconnects, these divergences, popping up right here at home in all sorts of different parts of the US market.
Okay, divergence number one. We're seeing transportation stocks, the trannies, they're a huge indicator of economic activity. And they're breaking away, they're underperforming the tech sector. Now, historically, when the stocks that literally move stuff around start to lag behind the high flyers, well, that can be a classic warning sign for the whole economy.
Divergence number two. What's up, Rose? Let's talk about the most speculative corner of the market, meme stocks. During the recent sell-off, meme stocks and the NDX, they fell together in perfect harmony. But on the bounce back, not so much. The meme stocks just haven't been able to keep up. And that suggests a subtle but really important shift in risk appetite. Maybe the froth is finally starting to fade.
Now this one is fascinating. Divergence number three. Here we're seeing this crazy divide between two different ways of looking at the exact same company, Oracle. This chart shows Oracle's stock price, and then the cost to insure its debt. That's a financial thing called a credit default swap, or CDS. So while the stock's been doing just fine, thank you very much, the cost of that insurance in the bond market, it's been getting more and more expensive. The credit market is basically pricing in a risk that the stock market is just completely ignoring.
And this isn't just about one company. No way. We're seeing a really similar gap forming between the entire US bond market, you can see it in the 10-year yield, and the S&P 500. And just like we saw with Japan, a very similar divergence popped up back in late October, right before the stock market took a nosedive to catch down with what the bond market was trying to tell everyone.
Okay, look, you can't talk about the market today without talking about AI, right? It's been the huge dominant theme that's been propping everything up. But even inside that powerful story, there are some little data points, some subplots that are starting to challenge its can't-be-stopped strength.
And we have to start with the undisputed king of the market, NVIDIA. See that big price gap on the chart? In the world of technical analysis, gaps like that can sometimes signal that a really powerful trend is getting, exhausted. They often get filled later on, which just means the price could drop back down to this level. It's just a little point of potential instability for the one stock that's been holding everything else up. And here's some actual concrete data. We're starting to see that the monthly growth in spending on stuff like OpenAI subscriptions, it's slowing down in major European markets. Now, look, this doesn't mean the AI revolution is over, not by a long shot, but it does suggest that the explosive, exponential growth phase might be starting to normalize. And that could be a real problem for the growth forever story that's priced into these stocks.
And all of this just feeds right into this huge debate that's happening in the market right now. Bobby Malavi over at Goldman Sachs summed it up perfectly. You've got the bull case, a new tech cycle, massive spending, friendly policy, and then you've got the bear case, fading catalysts, super narrow market, all crowded into that one AI theme, and a consumer that's getting weaker. It's two completely opposite stories for where we go from here.
So let's just pause for a second. We've got ripples from Japan. We've got divergences all over the US. We've got big questions about the AI narrative itself. And yet, when we look at the market's fear gauge, what do we see? Almost nothing. It's like volatility is completely soundly asleep.
That number right there, 16, that's been like a hard floor for the VIX index lately. Anytime fear even thinks about perking up, bam, it gets shoved right back down to this level. That real, genuine panic we saw back in November, poof, it's been totally wiped from the market's memory.
And this quote from Goldman Sachs really drives the point home. The speed, the sheer velocity at which fear was sucked out of the market in just 5 days. It was one of the biggest drops we've seen in 5 years. This wasn't a slow, gentle calming of the nerves. Oh no, this was a violent, VIX-stream reset right back to complacency.
So how can we measure this? Well, we can look at something called the put/call ratio. It's actually a pretty simple tool. It just measures the amount of bearish bets, or puts, against the amount of bullish bets, or calls. And it gives us a fantastic little window into how investors are really feeling.
And you know what? That feeling, it often follows this really predictable and honestly kind of painful cycle. First, you get the panic. The market drops, fear goes through the roof, and investors are forced to buy protection right at the bottom when it's the most expensive. Then you get the bounce. The market rips higher, and all that expensive insurance loses its value, like overnight. And finally, you get the puke. Investors sell that protection for a loss right as complacency is setting in again, leaving them completely exposed for the next big drop.
And that's pretty much exactly where we are today. Downside protection is now trading like it's for suckers only. Another way to say this is that market skew, which is just a fancy way of measuring how expensive that protection is at its lowest level in a while. Bottom line, insurance against a market drop is dirt cheap because almost nobody wants to buy it. And that is a crystal clear signal of extreme complacency.
Okay, we've covered a ton of ground here. We've seen cracks forming all the way over in Japan, inside the US market, within the main AI story, and even in the market's own psychology. Let's tie this all together.
So let's just run through the evidence one more time. We've got surging Japanese yields with a really troubling track record. We have multiple divergences between key U.S. market sectors. We have the credit market screaming a warning that the stock market is just plugging its ears to. We've got this dominant market story that might be showing some signs of slowing down. And all of it is happening against a backdrop of extreme, almost off-the-charts complacency.
Which brings us to one final and I think really crucial question. Look, it's not about whether any single one of these cracks is going to be the one to break the whole thing open. The real question is this. With so many of these little fractures forming just below the surface, is the market's biggest risk right now just the collective decision to ignore them all? That's the question to chew on. Thanks for joining us.